Hi, I'm Brooke Thackeray. Welcome to What's Hot and What's Not in the month of October. October has a reputation for being a very volatile month, and deservedly so. A lot of investors have seen the black and white reels of the 1929 crash and the ensuing depression. And also as well, the 1987 crash was not that long ago, where we saw the stock market on one Tuesday just drop precipitously down, and that really scared investors. So these memories are still investors' minds, and we have seen October also provide some other volatility outside of these two big notorious crashes in the past as well. And October, by the way, on a positive note, tends to be the month where most stock market bottoms are put in. And so the stock market can actually find a bottom in October and rally into the new year in November and December. In fact, November and December, on average, on a seasonal basis, are the two strongest contiguous months of the year. So the good news is we may see some more volatility here with the stock market heading lower. It's totally possible. But on the other hand, we're really heading into the sweet spot for the stock market coming up shortly. I know when I wrote my first book back in 1999 with Bruce Lindsay called Time In, Time Out, Outsmart the Market Using Calendar Investment Strategies. In this book, we really did an in-depth dive into the 6-month seasonal period. A lot of people call this sell in May phenomenon. And we established October 28th to May 5th is the optimal 6-month seasonal period. And so that's not too far away. So we could see the same thing take place. It doesn't mean it's going to happen this year, of course. Maybe the bottom happens earlier, maybe a little bit later, or maybe we do see some negativity even in November and December. It's totally possible. But on average, we start to see the stock market strengthen here towards late October. What I'd like to do now, though, is I'd like to dive in and take a look at the average seasonal trend for the S&P 500 in October, take a look at the sectors of the market on a ranking basis on a seasonal average gain from 1990 to 2020. And also, too, as well, I wanted to take a look at some of the charts for the different sectors that I'm talking about where we are right now, because there's a couple of charts that are really sending a message in the market right now of the market health, and I wanted to discuss those as well. So let's jump right in. We use the Thackeray's 2022 Investors Guide. I do want to mention that my Thackeray's 2023 Investors Guide should be available shortly in all major bookstores and online sometime in November. But we're going to be using the Thackeray's 2022 Investors Guide today. So let's take a look at the S&P 500 from 1950 to 2020. This is the average month for the S&P 500. Every month or every year for October is different, of course. But what you see is a general trend of the stock market performing well in the first part of October. And then we see some volatility happening in about 3/4 of the way through the month. Now, this has been skewed, of course, by the 1987 major correction that took place in this time period. But even excluding that, you do tend to find a pullback after the earnings start to get underway. Now, this year, we could see a little bit of a different story here. The stock market tends to rise into earnings season, but this year we're starting to see some major revisions from companies with their earnings and some comments about the economy not looking so good in the future. So we might not see that same strong burst that we've seen in previous years with some of the volatility that goes along with it. We may see a little bit more of a tempered or perhaps even a pullback in the first part of October. But October, towards the end of the month, has traditionally been a good time on a seasonal basis to establish a position in the S&P 500 and other stock markets as well, and in the last few days of October. If we take a look at the sectors of the market here, now this is from 1990 to 2020. The average, this is being ranked by the average gain here. So the information technology is a top performing sector. Now, the information technology sector is not performing well in 2022, but it does start a seasonal period very shortly, about midway through October. So it's something to watch out for, and we'll take a look a little bit at the technology sector in a minute. The consumer staple sector tends to be one of the strongest performing sectors. It's interesting that it's only outperformed the S&P 500 55% of the time, but yet, it's a boring sector, but investors tend to favor some of these sectors, such as the consumer staple sector, in what I call the transition time from the 6-month unfavorable period to the 6-month favorable period for the stock market, which starts in late October. So investors want to stay invested, and they tend to focus on the consumer staples sector. And then the financials tends to start to pick up here a little bit as well, but not particularly strong, at least on a frequency basis. I want to jump down to the bottom here and take a look at the industrial sector. The industrial sector tends to be one of the weaker sectors in the month, but it starts a strong seasonal period on October the 28th. So we may see a pullback in the industrial sector, which could lead to a good opportunity to get into that sector from a seasonal basis coming up shortly. In the energy sector, now the energy sector is affected by many different variables. And as we all know, it's been moving around an awful lot. But on a seasonal basis, ceteris paribus, everything else being equal, October tends to be a weaker month for the energy sector. It's only outperformed the S&P 500 35% of the time from 1990 to 2020. So it doesn't have a favorable seasonal period, a tailwind at this time. Of course, there can be other factors that could drive up the sector in this period as well. If we take a look at some of the subsectors here that tend to do well in October, the agriculture sector tends to perform well. In fact, it's outperformed the S&P 500 78% of the time from 1994 to 2020. Transportation tends to be one of the top performing sectors, but it starts the seasonal period a little bit later in October. So maybe a pullback might be an opportunity for that sector. We'll have to take a look. And the railroads also tend to perform well at this time in October. Now, I want to point out here in this case here, I want to go down here and take a look at a couple of the sectors at the bottom of the list here. First of all, let's start with biotech tends not to perform well in the month of October. Home builders. Now, home builders, we're seeing a correction in most of the housing markets across North America. And home builders are taking that on the chin a little bit. Rising rates has definitely hurt that sector overall. The prospects for on a go-forward basis. October tends not to be a good month for the home builder sector, but it does start a strong seasonal period late in October. So you could see a pullback that could lead to an opportunity, at least in the short term, for that sector. And if we take a look here, metals and mining tends to also be one of the weaker performing sectors. Now, recently we're seeing a little bit of life in that sector. So we might see that actually buck the trend here a little bit. Gold, 26% of the time, it's only outperformed the S&P 500 from 1990 to 2020. Historically, October has not been a strong month for the gold sector. It finishes a strong seasonal period October the 9th, and typically after that, we see some weakness in gold. Now, I want to say that we have seen some stability happening in the last few days of September in the gold sector, and with all the concern around the Bank of England having to go to quantitative easing on a temporary basis, maybe not temporary, but they're claiming it is. And also, too, some of the systematic risk that investors are fearing. Gold's starting to show some stability, so maybe we do see that it's bucked the trend overall. But seasonally, October has not been a good month for gold, and the same for silver. Perhaps a pullback in these sectors would provide an opportunity here. Now, they both start their next strong seasonal period in late December, and there can be a lot of volatility that occurs in this time period as well. So maybe we do see a start to this a little bit early, but it should be noted that there is a headwind for both of these precious metals at this time. I want to take a look at some charts right now and where we are in the market. From a quick summary for the S&P 500, I want to get into some of the sectors that tend to do well on a seasonal basis at this time of the year as well. So here, first of all, let's start with the S&P 500. Here's the S&P 500. We're now below the June low for the S&P 500. So we're seeing some poor performance for the S&P 500. And we've really seen a big pullback in the month of September after a strong first half of August, and we've seen a little bit of a pullback in the remainder of August, and then September a pullback further. If we take a look here and we take a look at the go across on this line here, this here was a double bottom breakout. So we went up, down, up, and then we had a breakout that occurred right here. And we're now back down to approximately that level. So this is a major level of support for the market. So we could see the S&P 500 pull back lower from this point. It's totally possible. And if you had to say, well, where's the next level of support? Major level of support would be the bottom of that a double bottom breakout, which is around 3,300 approximately. So we could see the stock market pull back here a little bit further with some volatility in October. Now, from an RSI standpoint, here we've become oversold in the market, but we're not seeing signs of it actually turning up at this point. But we could see it actually start to move higher in the future, which would be a positive sign. I wanted to show you the chart of the utility sector. This is an important chart because something's happened recently and it's giving a signal that's not very good for the markets overall. So here we're using XLU, the ETF that trades in the US, versus for the utility sector. This chart is the utility sector versus the S&P 500. When the line's going down, it means that the utility sector is underperforming. When the line's going up, it means it's outperforming. In fact, that's exactly what we've seen in 2022 for most of this year. Is we've seen the outperformance with some bumps and wiggles along the way of the S&P 500 underperforming the utility sector. But overall, what's taken place is, even despite rising interest rates, there's something else I want to point out. Here's the start of 2022, and up until early September, the utility sector was actually positive for the year. So it was, what we've seen is investors leaving some of the growth sectors and going into the utility sector, even when interest rates were going up. And so why were they doing that? They were moving into the utility sector because they wanted to stay in the stock market. They wanted to reduce their risk, but stay in the stock market. And so they moved into the utility sector. Well, that's changed a little bit recently. In the last couple of weeks, what we've seen is utility sector heading down lower and also underperforming the S&P 500, even as the S&P 500 has moved lower. This is a new shift. So what could it possibly be signaling? Well, perhaps what's happening is investors no longer shifting from growth into the utility sector. They're not wanting to stay in the market. So it looks like some investors are actually leaving the market subtly instead of rotating into some of the defensive sectors, which is not a good sign for the market. It's showing that investors are starting to really get concerned, and maybe they don't want to have the same level of investment in the overall market on the margin. This next chart isn't a sector at all. In fact, it's a company. I thought I'd just put this in here because I include it in my 2022 Investors Guide. It was a new seasonal trend. And this is for Microsoft. The strongest month of the year for Microsoft is October. And if we take a look here, I just want to jump back to my book here. I can show you here, this is the trend from October the 1st until October the 31st. Now, it doesn't mean that this is going to happen this year. Overall, you can see here the positive trend from 1990 to 2020 all the way down. The average gain has been 4.9%, and it's been positive 71% of the time. It's outperformed the S&P 500 by 3.6%, and it's outperformed 71% of the time. So if there's one month of the year that you want to lean towards perhaps investing in Microsoft, it would be the month of October, and we can see it here. This stands above all of the other sectors. The average is the bar, and the cross is the median. Both are well above the S&P 500. So something to consider, at least from a seasonal point of view. Microsoft for the month of October. It doesn't mean it's going to be positive or outperform the market, but it does have that seasonal tailwind helping to support the market. If we go back to the charts and take a look here for Microsoft, we can see that on an absolute basis, it's headed lower for the year, and it's actually underperformed the S&P 500 as well. Now, it hasn't done nearly as badly as the technology sector overall. Investors are still looking at Microsoft as almost like a hotel for risk in the technology sector. This has been one of the preferred stocks in the sector as investors have gone into this versus some of the other technology stocks. It has become oversold on an RSI basis as well, but there's no guarantees that we're going to see the Microsoft outperform this year, but you should know about the tailwind on a seasonal basis that could help Microsoft, especially if we see a risk-on mode take place a little bit where investors shift back to being positive on the markets. This might be one of the first stocks that they start to come back into as well. Given that we were looking at Microsoft, I also wanted to take a look at the technology sector, which starts a strong seasonal period coming up shortly in mid-October. Here you can see on an absolute basis, the sector has not performed well and it's also underperformed the market, but really it's been performing at market really since about April with some ups and downs here. So we've seen this consolidation period taking place relative to the S&P 500. This is actually a fairly good setup for the sector itself. So if we do see a bottom take place in the market in October, maybe it's a little bit later than the mid-month for the technology sector this time around. Maybe it's towards the end of the month. We could actually start to see the sector start to outperform the S&P 500. If we move into a risk-on mode, the market starts to perform well. So this is a time where the technology sector tends to pick up, particularly towards the end of the month relative to the S&P 500. So if we do see that correction that takes place, this could lead to a good opportunity for the technology sector. I didn't discuss Canadian banks earlier. It wasn't in my chart, but it's a lot of Canadian investors look at Canadian banks as a core part of their portfolio. Canadian banks that start their strong seasonal period in mid-October here and lasting until the end of the year. Canadian banks in general will start to release their earnings as a group in the last week of November. So sometimes if we do see a run in the Canadian banking sector in October and November, and it's a strong run, sometimes the banks will pull back on the earnings. But overall, their strong seasonal period is from mid-October to the end of the year. If we take a look at the relative performance, well, the average performance, or the absolute performance, I should say, we have seen the sector actually head down overall relative to the TSX Composite. We have seen a consolidation taking place recently for the sector, and we've seen back up into the top of its trading range for the sector. Now, Canadian banks pay a high dividend. They're an oligopoly business, so a lot of investors do favor them. When the market tends to start to turn down, investors tend to be attracted into the Canadian banking sector. The danger with the Canadian banking sector ultimately will be if they start to increase their loan loss provisions, and then we start to see that last quarter. But they really get into that if there's a real belief that we're going to head into a major recession for the economy. It's possible to start to see the Canadian banks underperforming. That hasn't happened yet. Maybe it's a little bit later on. Maybe it's the springtime with the housing market, but something to watch out for. But right now we're starting very close to the strong seasonal period for Canadian banks, making an attractive opportunity perhaps in the short term, at least until the end of the year. I want to show you a chart of the industrial sector because the industrial sector is one of the weaker performing sectors in the month of October, but it starts a strong seasonal period later in October. So it could be an interesting sector to get into. If we take a look here, this is the, in this case, here's an XLI in the US, and this is XLI relative to the S&P 500. And we've got a case of rising bottoms here, which is actually quite positive. And here we are, we're seeing increasing highs as well, but the fact that we've seen rising bottoms relative to the S&P 500 is positive. Perhaps we do see a pullback further for the sector, but given that the strong seasonal period starts later in October, if we do see a big correction, this could be a very interesting sector to pick up. It's right now, it is oversold on an RSI basis, so we could see a little bit of a bump here, but a pullback could lead to an interesting opportunity later this month. The uranium sector starts its strong seasonal period in early October. We've seen a lot of volatility in the sector. Uranium has really been in the news recently with a lot of countries extending their nuclear power plants or introducing new nuclear power plants. In general, what we've seen is the Green Initiative is starting to incorporate more nuclear power as the mix for a sustainable energy in the future. And this has been positive for the uranium sector. But nevertheless, the uranium sector is still a negative for the year 2022, and we have seen some volatility taking place. So if we take a look here on an absolute basis, we've really seen this pattern taking place. We're right now in the middle of the pattern here. We do start the strong seasonal period, which means that when that happens often, you can see a little bit of an uptick, perhaps back to the top of this strong trend line. And relative to, in this case here, I'm using URA, Global X Uranium and the ETF in the US, and this is relative to the S&P 500. And it's the same. We've seen a little bit of a weakness recently as well for the sector. If we see a risk-on move in the markets, and we do see some strength in the metal sectors, this sector could actually benefit quite strongly. It does start. Here's a chart of natural gas. Natural gas is extremely volatile, and it can move up a lot and down, and big losses and gains can be made for this. And investors have to be extremely careful with natural gas overall. From a seasonal point of view, we see natural gas starting to improve its strong seasonal period. We'll start a strong seasonal period in early September into mid-December. And what we've seen this year here is we didn't see that. The natural gas has actually pulled back down on an absolute basis really since the start of its strong seasonal period. Now, the real sweet spot to the strong seasonal period is November. So if we do see some volatility taking place in October, this could actually be lead to a good pickup for natural gas from a seasonal point of view a little bit later on. We still are in this upward trend line, or approximately so, for natural gas. We haven't had a major breakdown, and really natural gas, the next level of support is around 5.5 for natural gas. So we're still above that support level. We could see, if we do see some volatility taking place in October, it could present a good opportunity from a seasonal point of view as we hit that real sweet spot for natural gas in November. There are no guarantees in investing in the stock market. It's been extremely interesting as we've seen this downturn take place for the S&P 500. Most of the correction for the S&P 500 has taken place in the 6-month week seasonal period for the stock market starting in early May. And we've seen the Federal Reserve in this real hawkish tightening scenario taking place. We're seeing a stronger US dollar having a wrecking ball effect on different assets around the world. So we're seeing a lot of volatility taking place in the markets. Investors really haven't had any sort of big capitulation in the markets yet, with as demonstrated by a lower, well, not low VIX, but not a level of 40 or above, which would indicate some sort of capitulation. That just hasn't happened. And October tends to be this really volatile month. We can see the stock market start to go further, or start to really pick up in October, particularly if there's a strong belief that the earnings were going to be solid and really support stronger growth. But right now, that doesn't seem to be the case with the earnings. We're seeing some revisions taking place. We're seeing some really negative comments by some really bellwether companies, the CEOs coming out and talking about economic conditions not being as good as what they expected. And that could have an impact as well. So we may not see that big earnings effect taking place. A lot of volatility happening right here as well. And the volatility in the past, when October has been volatile, it has presented good entry opportunities as well. Perhaps that's the same that happens this year round. Maybe it happens later. Maybe it's in November or even December. But on average, on a seasonal basis, October tends to have the most big major stock market bottoms take place in a rally into November and December. So this is going to be an interesting month to get through. We're seeing all sorts of ripple effects or second order effects in the marketplace that are investors really haven't accounted for. We saw that with Japan having to intervene in the FX market, and then the Bank of England changing from a quantitative tightening to quantitative easing on a temporary basis to help the pension funds provide liquidity into the marketplace. So who knows what's next, because as the US dollar moves up and the S&P 500 is being moving down, this is having a wrecking ball effect, and there could be some other consequences along the way. But the good news is, from a seasonal point of view, we tend to be in that period where the stock market does put in a bottom here. So we could see that happen, particularly later on this month. Thank you very much for joining me today.